what's up, everybody? It is, Wednesday, March 3rd. So we had another sell-off in the market today, mainly the NASDAQ. Now, I don't think this is anything to get concerned over. I think we had bullish sentiment, got too high, and okay, we did have that spike up in bond yields, and I'm going to talk about that. We also have the ongoing inflation concerns. We probably do have a bit of, higher inflation, but I don't think it is anything that is going to derail the market right now. And look, Congress is very close to passing the 1.9 trillion Biden stimulus, so that's going to be a positive. So let's talk about the bond market. Some of you have been asking me about the bond market. Couple of things going on here. Number one, you got the whole inflation scare. Now, if you recall, I was a long way back into last year talking about how the inflation trade was how you ought to be positioned. And of course, that ended up to be completely correct. And a lot of people have jumped on that trade recently. Insofar as the bond market is concerned, two things going on. Number one is, investors are, thinking about that inflation trade. They're worried about that inflation trade, and they're selling treasuries. There's been a lot of hype too. We saw that comment from that the big short guy, Michael Burry, how there's going to be like Weimar style hyperinflation, which is nonsense. But, these headlines, they get people all excited and they get them to do things. And I talked about this the other day. We saw a very significant amount of short selling in the futures markets of 10-year Treasury notes. Small speculators particularly really ramped up a very big short position in a relatively short amount of time. They were short as of the last data, which is through February 23rd, they were short 184,000. That's net short. So that's shorts minus longs. They were net short 184,000 contracts of T-notes. That is, in notional terms, 18 billion worth of bonds. Now, alongside that, the second factor going on is you have reserves building up in the banking system. And I've been talking about that for a long time. I've been explaining that when reserves go onto bank balance sheets, those are part of bank assets and they need to conform to certain regulatory ratios, one of those being the supplemental leverage ratio. And that's their capital divided by their consolidated assets. So when their assets increase, if their capital doesn't also increase, that shrinks the ratio, all right? And it may put some banks in a position where they have to shed some assets or raise some capital. Now, what we have been seeing is in the period from, let me get this right, January 21st to February 17th, the banks sold 34 billion worth of treasuries. So you had banks selling treasuries, 34 billion, and you had small speculators going short a notional value of 18 billion. So what's that? 52 billion liquidation of treasuries. Now, when you talk about the treasury market, which is in the trillions, that's really not a lot. But at the margin, like economists say, that could push the market. I mean, we used to do that down on the floor with one lots. We used to push the market around. So 52 billion of selling in a relatively short period of time, like in the last 3 weeks, that pushed down bond prices. It pushed up bond yields. Now, some of that selling may continue because this whole phenomenon of reserve additions onto the banks, that's going to keep on going for a while because the Treasury has indicated it's going to bring down its balance in its account at the Fed. So when the Treasury spends, that flows into the banking system as reserves, and you get the idea. I don't think it is something fundamentally that we have to worry about, because the Fed is keeping interest rates fixed right where they are. If the Fed was saying, hey, we're going to start raising interest rates, and it's an open-ended deal, now that would be something else, because the term structure would start to reflect that. We'd see, rates go up all along the term structure and continue to go up until the Fed would say, all right, we're done. But the Fed is not saying that. So what's happening now is more or less a technical situation, and also, I call it like bonds are the new GameStop. Like all of a sudden, all these little speculators and all these little investors are into shorting treasuries. It wasn't too long ago that it was not so easy to open a futures account, but now every major brokerage firm, you could trade futures. I mean, if you're in Schwab, if you're in TD Ameritrade, I don't know if Robinhood does it, but I mean, Interactive Brokers, they all have access to futures. So that's basically what's going on. I mean, bonds have become the new GameStop play because everyone has bought into this inflation, hyperinflation outlook. I'm skeptical on it, at least to the degree that it's being portrayed. Now, remember, I was the guy originally who said, yeah, we're going to see some inflation. We're not going to see hyperinflation. And as the economy opens up, a lot of these factors that have been contributing to price increases, such things as supply chain disruptions and this kind of stuff, production slowdowns, I mean, that's going to start to loosen up. So you're going to get more supply. And with more supply, prices will moderate. Now, I still think we're in a growth environment. And if we are in a growth environment, stocks are going to be okay. And getting back to stocks right now, I mean, if you look at the market averages, the main ones, the S&P, the Dow, and the NASDAQ, this pullback is completely within the realm of what you'd expect to see after like a really high level of bullish sentiment, which is what we have seen in the past few weeks. So, I'm not concerned. Some people are saying, hey, Mike, aren't you worried? Aren't you nervous about the market? No, I'm not nervous about the market, especially with another stimulus coming. I mean, we're already, we're up 640 billion over where we were last year. The deficit is at like 1.13 trillion already. That's over 5% of GDP. And remember, what is the deficit? The deficit equals the net addition to the financial balances of the non-government. That's us. So I mean, 1.13 trillion, we're not even halfway through the fiscal year yet. We're going to be well over 2 trillion again, net addition. I mean, if they were sucking income out, if they were sucking savings out, in other words, if they were running surpluses, yeah, I'd be really, really worried. And I'd be short everything and just staying with a short position. But it's the opposite. That's not what's going on. The fiscal pump is on. It's pumping out at a high rate. I mean, you just can't get bearish when that's happening. You got a technical situation here now with this reserve build that, is causing some disruption. But look, in the latest bank data that I saw, even with that reserve build, the banks actually upped their lending. So they're not in any kind of trouble whatsoever. They upped their lending, which is a good sign, because if credit demand is increasing, what does that say about the economy? It means the economy's getting better. So everybody got to calm down, because things are all right. Hey, I just uploaded a new podcast. The link is in the description below. I talk about some of this stuff in there. Go check it out. Send it around. Share it. All right? And I'll see you tomorrow. Bye-bye.